Hello, this is your daily dose of financial market trends. Bond vigilantes are rattling their sabers, and the Fed's credibility is on the line. When central bankers start warning about their own institution losing control of inflation expectations. Markets listen. Heading into this morning's open, we're looking at Friday's close numbers. The S&P 500 finished at 7,489, up 0.7%. The Nasdaq added a full percent to close at 25,374, while the Dow gained about 0.5%, closing just above 52,485. The VIX ticked down slightly to just under 16, but the real story was the 10-year Treasury yield, which jumped 1.7% to 4.74%. Let's dig into what's moving markets this morning. AMD is commanding serious attention across multiple channels right now, and for good reason. The chip giant is facing pressure from multiple angles. Shares dropped nearly 2%. Friday, volume patterns suggest institutional repositioning, and the stock is caught in the crossfire of increasing tech fragmentation between major economies. With earnings dropping tomorrow after the close, investors are weighing whether AMD can navigate a world where digital borders are hardening and chip supply chains are fragmenting. The timing is tricky, especially as geopolitical forces threaten the seamless global tech ecosystem that's powered semiconductor growth for decades. Amazon had a wildly different Friday, surging over 15% on volume that ran more than double the usual pace. The e-commerce and cloud giant is showing up across news feeds, social chatter, and unusual activity screens simultaneously. That kind of coordinated signal across multiple data streams typically means something fundamental shifted in the investment thesis. The stock is also appearing in discussions around how cloud providers might handle fragmented data sovereignty requirements, which could either become a costly headwind or a moat-widening opportunity depending on how regulatory frameworks evolve. Apple tells the opposite story, down over 7% Friday on more than double normal volume. That's the kind of move that gets attention when it happens to a $3 trillion company. The decline is hitting just as conversations intensify around digital protectionism and data localization requirements that could force Apple to rebuild infrastructure region by region. For a company that's mastered global supply chains and unified ecosystems, a fragmented digital world represents a fundamental challenge to the business model. Rounding out the picture, crude oil exposure through USO is spiking in mentions as Middle East supply concerns resurface. The ETF gained over 1% Friday, and the social conversation volume has exploded. When oil chatter jumps like this, it's usually a leading indicator that energy is about to matter again for broader portfolio positioning. 3 macro scenarios are shaping risk assessments right now. First, the Federal Reserve credibility crisis that's unfolding in bond markets. Recent Treasury sell-offs have senior central bankers openly worried about losing their grip on inflation expectations. The bull case, at 40% odds, is that the Fed signals more aggressive tightening or takes hawkish action that re-anchors expectations. If that happens, yields stabilize as confidence returns. The yield curve steepens to benefit banks, and the stronger dollar pressures commodities while supporting tech service exporters. The bear case, at 30%, is that the Fed stays dovish despite persistent inflation signals. That path leads to accelerated bond selling, 10-year yields potentially jumping another 75 to 100 basis points. Severe losses across fixed income portfolios. And financial stability concerns, as regional banks face deposit flight and mounting unrealized losses. Second, the digital iron curtain and global tech fragmentation story. Data sovereignty requirements are carving up the global tech ecosystem, threatening cross-border flows and integrated supply chains. The 25% bull case envisions major economies negotiating new frameworks with interoperable standards that let cloud and semiconductor companies maintain market access through smart compliance architectures. The 55% bear case is grimmer: incompatible technical standards, mandatory data localization, and restricted tech transfers force companies into costly regional infrastructure duplication, compressing margins and potentially cutting revenue growth 15 to 25% in affected markets. Third, the AstraZeneca-Bristol-Myers Squibb potential mega merger, creating a $400 billion healthcare giant. The 35% bull case sees regulators approving the deal, unlocking major cost synergies through consolidated research and supply chains, with the combination triggering broader defensive pharma consolidation. The 45% bear case has antitrust concerns, or shareholder opposition killing the transaction, forcing both companies to prove standalone growth strategies amid patent cliffs and biosimilar competition, potentially dampening deal appetite across the entire sector. The 30-year mortgage rate sits at 6.66%, barely changed from a year ago, yet existing home sales actually grew nearly 3%. That's the key test. Can housing function at these rates? Inventory is building to over 9 months of supply, and if sales growth stalls here, builders face real margin pressure and potential production cuts beyond what permits are already signaling. AMD reports tomorrow after the close, and given everything we just discussed about chip fragmentation and geopolitical pressures, the forward guidance on that call might matter more than the backward-looking numbers. 5 things worth watching as this week unfolds. First, bond market behavior is your early warning system right now. If 10-year yields keep climbing despite Fed rhetoric, that credibility gap is real, and equity valuations will feel the pressure. Second, tech fragmentation is moving from theoretical risk to actual cost center. Companies reporting earnings need to address regional compliance costs and infrastructure duplication, or the market will assume the worst. Third, defensive sectors like healthcare might see renewed M&A activity as management teams look for growth through deals rather than organic innovation, especially in pharma, where patent cliffs loom. Fourth, housing is testing whether the economy can function at 6.5% mortgage rates. If that 9+ months of inventory keeps building, home builders and related consumer discretionary names face real headwinds. And fifth, energy is quietly creeping back into the conversation as geopolitical supply risks resurface. As always, this is educational content, not financial advice. Do your own research and consult a professional before making investment decisions. That's your Morning Market Digest for Monday, August 3rd. We'll be back tomorrow morning with whatever the market throws at us next. Trade safe out there.